Hey, David. Welcome to the His and Her Money Show.
Hi, good to be here. Thanks for having me.
Oh, we're glad to have you. You are a great, valuable resource to people, especially in the area of investing and really personal finance overall as a whole. So we're super excited that you were able to find some time to make this happen, as we've been a fan of your work for many, many years. But for those who may not be familiar with you at the moment, can you just take a second or two and let them know what you're all about?
Sure. I run a podcast called Money for the Rest of Us, and I have an education site that goes with that. I've been doing that for just about 4 years. I have 200 plus episodes. And prior to that, I was an investment advisor and institutional money manager. So working mostly with endowments and foundations. And then I co-ran we had a 20-person research group. So I was our firm's chief investment strategist. But for the past 4 or 5 years, I've been out on my own doing the podcast and just educating people about money and investing, the economy, and how it all works and ties together.
So talk about that transition, because you were in the thick of the financial world. You were like at the top for a lot of people, in their estimation, would say you made it. You had arrived in the financial sector, and then you decided to retire early and start this quest that you're on right now. So talk to us about how that all came about.
Well, I think sometimes when you arrive, you realize that's it. So I specifically remember probably 5 years ago speaking at our firm's client conference, and I'm up on stage and have my partners are watching me, our clients, a few hundred people. And sometimes as you talk, you kind of have a dialogue going in your mind. And I remember giving my speech thinking, like this is it, right? I mean, there is nowhere else to go. And frankly, I was a little bored. I was in my mid 40s, and I just didn't want to wait out the clock for the next 10 years. My partners, we were all kind of the same age in our 30s and 40s, and I was ready for something new. Plus, we wanted to do more travel as a family, and I thought, hey, it's been fun. I've been with my partners for 17 years. I'm going to try something else, and that's what I did.
How did you set yourself up to be able to do that in your 40s? Because a lot of people, 40s and retirement don't go together. They're not synonymous. But you positioned yourself in such a way that when you had these thoughts like, I think I want to do something else, you were actually able to execute on that because of whatever decisions you made prior to that moment. Are you able to elaborate on how you set yourself up in that way?
Well, sure. I mean, we've always been big savers. My partners were in Ohio. I telecommuted from Idaho for over a decade, and there's this idea of income arbitrage where you're making a very large salary but living somewhere with lower expenses. But at the end of the day, we had sold the firm back in 2000 or 2001. We bought it back in 2005, and it had done very, very well. It was a leveraged buyout, a lot of debt, but sometimes when you take a big bet like that, I mean, we signed personal guarantees on that debt, but it had done very well. So that transaction was enough to really have a nest egg that I didn't really have to worry about it. So I knew when I quit, I had 3 to 4 years to figure out something to do. I wasn't quite sure in what form it would be, but ultimately having that nest egg, having that after-tax savings made it a lot easier. I mean, I admit I like to think I'm an entrepreneur, but honestly, when you have sort of this nest egg, it's just not as stressful as if you're starting from scratch.
Now, a lot of people have difficulty when it comes to money management. It is a thorn in many people's side. They are highly intelligent people. They are advanced in their careers. They know their specialties well, but struggle in the area of personal finance management. You've helped a lot of people with their money, and you've given a lot of advice. Why is this such a difficult thing for people to get a hold of?
Well, I think our emotions get involved. And I think what I often see is people sort of approach it the wrong way, in that they see Bitcoin or they see gold or something that's doing well, and they want to be a part of it. They have this fear of missing out, as opposed to stepping back and saying, this is my long-term savings. I'm not going to try to hit home runs. I'm just going to try to save as much as possible and start little by little to get education. Start with your 401k. Understand, well, what are the options? What do these different funds even mean? And it's just a small step-by-step incremental process where you start to get confidence that, yeah, I know something about investing. The other thing you have to recognize is nobody really knows. I mean, there is no expert out there that knows exactly what's going to happen that you can go find. They'll tell you what to do. Nobody really knows what the economy is going to do 2 or 3 years from now. I mean, there's some indicators we can look at, but generally speaking, it's best to just to save as much as we can and start small, and then gradually you start to gain confidence in the ability to control your emotions, so you're not whipsawed by the latest news headline or the latest investment fad.
Now, your podcast, which is great, by the way, is called Money for the Rest of Us. And you take these really big financial themes and topics, and you help the people like me, people like the listeners, understand it so much better, because I don't have a finance background. My wife does, but I don't. And, sometimes when I read a magazine like a Black Enterprise or a Forbes or a Money, or I watch Fox Business or a show like that, or Mad Money, and like they throw out these terms, some of the words are so big that it just automatically makes me want to turn the channel. And a lot of times that can just be overwhelming to the point that you do nothing. And for years, I was in that place to where I was just like, you know what, I don't get it, so I'm not going to get involved. How do we avoid letting those thoughts manifest in us to say that since I don't understand, and it really seems very difficult to navigate the stock market, I'm just going to stay away?
Well, I think people throw out terms because it makes them feel like they're experts. In my case, I spent many years working with not-for-profits, working with boards, and I realized right away I could not throw out a term without defining it. And so it only takes a few times people say, I don't know what you're talking about, to sort of simplify it. And I think investing isn't that hard. You're dividing up your money. You want different return drivers, and you basically need rules of thumb. You don't have to be an expert. You just need to have, what it's called an effective theory, enough knowledge to get by. And recognizing, because it's extremely complex, and it can be more complex, but that's not what we're trying to do. We're just trying to do well enough. And an analogy, we've been traveling for the past several months, and in every hotel or Airbnb we stay at has a different faucet mechanism in terms of how you turn it hot or cold or get the shower to come out of the right faucet. Well, I don't have to be a plumbing expert. I just need to know that the 3 rules of thumb of turning on a faucet. I need to know the difference between the cold and the hot, the water pressure, and to get it out. And investing is the same way. We just need to know some basic rules of thumb, diversification, understand what drives returns of different asset types. So, really, in my approach has always been to narrow it down the universe and just focus on asset classes, as opposed to trying to buy individual stocks, options. Put your focus on learning what are asset types, what are stocks in general, what drives the returns, what are bonds, what is it that drives those returns, and how does it all work together?
How do we figure those things out if we're brand new? Just like we know we want to invest, we know we need to invest, but I'm at the place where I don't know those things. I don't know what a stock is versus what a bond is. What do you mean by asset classes? You know what I mean? Like, how do we start even picking up that knowledge to get to the point to where we know enough to get by?
Well, I mean, there are some great, very beginner investment books out there that'll define what a stock is. A lot of, Vanguard, for example, they have good educational materials. So there's things out there to get the very basis. Certainly listen to a podcast like yours, a podcast like mine, or other podcasts. Really what you're trying to find is a virtual mentor. So there's so many resources. So you want to find somebody that you resonate with. So maybe one's still working on budgeting or the very basics, or they're trying to get out of debt. So maybe Dave Ramsey is somebody they listen to. But over time, they find somebody they resonate with until they kind of get that core knowledge, and then maybe go on to somebody else. But it's a lifelong process to learn to invest. You don't want to wait till you have money to start learning to invest. I mean, right now there's so many Robinhood apps, for example. You can buy a stock or an ETF with hardly any money at all, or different brokerage firms have a commission-free ETFs. The other day, my sons are in their 20s, just getting started. I mean, they have $100 in their IRA, individual retirement account. They wanted to diversify, so we bought one share of one ETF. Actually, we bought two ETFs, one share each. Well, there's no commission, so you can do that. You can take $40 and buy an ETF, and so then the natural question is, well, what is an ETF? You know, what is this fund? And you recognize an ETF, an exchange traded fund, is just it's a wrapper, it's a vehicle, it's a asset that you can buy that invests in a number of different, in this case, underlying stocks, which stocks are essentially ownership in a company. But the tools are out there, just putting in the time to do it. And now's the time to do it when you're young or you don't have a lot of money, because at some point you're going to have several $100,000 of savings, and you're going to be scared because you won't know exactly what to do, and you can be taken advantage of if you don't have that core knowledge.
I think that, based on, news reports or based on who you ask, you get varying answers to whether or not it's a good idea to even invest in the stock market at all. Why, for somebody who's like teeter-tottering back and forth with that thought, why is investing in the stock market something that they should consider?
Because of all the different types of investing, a broad-based exposure to stocks. So let's say an index fund or an ETF that invests in hundreds, if not thousands of companies, that has earned more over a century than any other asset class. And so if you're trying to accumulate savings, you want what has done the best in terms of within reasonable risk. And so, in fact, one of the things I'm talking about this week on episode 204 is we're looking at the long-term history of the stock market. And Elroy Dimson puts together a study along with Credit Suisse, and they looked at 118 years of stocks globally. They have 21 or 23 countries in their sample, and they compared it to cash versus stocks. And generally, it's returned about 5.6% per year more than just holding cash. And so, and that's, you get paid for it. I mean, there's risk, there's the ups and downs, but you get compensated for that risk. So start at that as your base, and then you add other things on top of that. So, because I've never been somebody that says, well, just all in stocks. Some people say, well, that's the best, I'm going to put 100% of my assets in stocks. Well, there are times when stocks haven't done well over 15-year time horizons. And so having other types of assets and learning about real estate, for example, having things outside of the stock market, such as maybe have some gold coins. I mean, there's not a right percentage necessarily, just having many different types and recognize the difference between, what I call what's an investment versus what is speculating. And this is where people often make mistakes. Speculating is where there's not real clarity whether it's going to be positive or negative. An example of that is Bitcoin. Everybody's talking about Bitcoin right now. Well, Bitcoin doesn't generate any income. It's worth whatever people are willing to pay for it. And so it bounces all around. Versus an investment has a positive expected return, because that usually has an income stream. There's those companies that you own through a stock index fund are paying dividends, a share of their profits. So you have income. If you own real estate, you have income in terms of rent. If you own bonds, there's income in the form of interest. And so as a result, having something that generates that income gives it a positive expected return. That's an investment, as opposed to a speculation that there is no income oftentimes, and so there's some difference of opinion. And then you have gambling, where you have basically a negative expected return. Playing the lottery or going to Vegas, it's fun for some. I don't spend much time doing it, but some find it entertaining. But that has a negative expected return, because usually the house wins, because otherwise they wouldn't be around.
And there are, even within the stock market, there are different types of investment options that you can do, different vehicles, individual stocks, or a mutual fund, or an ETF, and I just think that there are so many options that, again, because of the plethora of choices, can turn people off because of information overload. What are some of the options that are there that maybe we should research further instead of trying to figure out everything that's available?
I would focus on index mutual funds or exchange traded funds. So, and the difference, a mutual fund, there's a manager that owns hundreds or thousands of stocks and has very low fees. And so that's one option. And an ETF or an exchange traded fund is just like a mutual fund, but it trades on an exchange. Sometimes exchange traded funds have lower fees versus an index mutual fund. And so I often will use ETFs for that. I don't spend time researching or investing in individual stocks. I mean, that could be entertaining. I spent many years interviewing, conducting due diligence on stock managers or bond managers, active managers that were trying to find individual companies. It's really hard to do because that's their full-time job. And so if we're just sitting back with my Robinhood app and I want to buy this stock, well, yeah, that might be fun just to kind of get an idea how stocks move. But you have to recognize the stock market is an auction market. There's somebody else selling you that company or that stock. And they, by and large, most stock trades are by institutions. So whoever's buying it knows way more than I would when I buy that stock. And so I don't have any type of informational edge to be able to outperform or to do well. I mean, maybe the stock will go up, but the only reason you want to buy an individual stock is you think it'll do better than the overall market. And the only way it's going to do better than the overall market is if investors collectively have underestimated its prospects. If you buy Amazon, people think, well, Amazon's a great company. Well, Amazon's really, really expensive as a stock. And so in order for it to do well, it actually has to do better than what all the other investors think it's going to do. And as an individual, how am I going to know whether Amazon's going to do well or not? I mean, in some ways, that's like gambling because I don't have any insight. So if you focus on asset classes where you're focusing on global stocks and you're focusing on overall bonds, and I mean, you could basically run an investment portfolio with just a couple ETFs or funds, and then you're there, and then that's sort of a starting base as you continue to gain knowledge.
Policy Genius guarantees the best life insurance price for you and those you love. It's so simple to protect your family today in 5 easy steps. 1. Calculate quotes. 2. Compare companies. 3. Apply online. 4. Receive expert advice. And 5. Rest easy. It really is that simple. Calculate, compare, apply with Policy Genius. For more info, head on over to hisandhermoney.com/Policy Genius.
Now, you mentioned earlier in the episode, a great place that a lot of people can start is through the 401k options at their employer. But even in that endeavor, sometimes you get that little booklet from your HR rep and it's got all these different funds and all this information about each one. When we go into that trying to, get our start and pick the best options within our 401k opportunities at work, what are some things that we should consider as we're looking throughout this paperwork?
Well, the easiest way to do it is most 401k now offer some type of lifestyle fund or a retirement fund. So it might be a 2030 fund or a 2040 fund where you say, okay, I want to retire in the year 2040. You buy that fund and that fund manager invests in a number of underlying asset classes. And so you're able to just with one fund get that diversification. And that's the easiest way to do it. If you don't want to spend time researching all the different options, just figure out which year you want to retire or estimate and buy that one fund. After that, you can start learning about the other options. Usually there's some type of stable value option or which is basically that's probably the lowest risk option. There's usually you want to buy one of the stock ETFs, usually hopefully some type of having both U.S. and non-U.S. exposure, and that's about it. I mean, you don't have to learn about every option. Sometimes they overdo it. So see which ones have the lowest expense ratios, the lowest fees, because usually in your little list they'll show that, and that's another way to screen it. But starting with that, what are known as target date funds, the 2040 fund or 2030 fund, that's really the easiest way to start.
I read where you said that when you're investing, that a person should always be investing with their eyes wide open. Can you kind of elaborate on what you meant by that?
Well, I think it gets back to having a core knowledge. And an example, a number of years ago, I was out at our farm and we had a kind of a mouse problem, and I had the exterminator came, and as he was kind of doing what he does, putting out some bait boxes, he asked me, well, what can we earn investing? And how much can I earn investing? What rate of return is reasonable? And before I could even answer, he said, I think it's 80% per year. And I said, how did you come up with that number? Well, it turns out that's what he had earned buying a stock that year. And so that was sort of how he anchored his returns. And he thought, well, that's what stocks should do. Well, that's not investing with your eyes open. That's sort of having one little experience and extrapolating that the rest of your life. So we always have to go back and trying to figure out, is this reasonable? Starting with a target date fund, that's a reasonable approach. Recognizing, and again, it just eyes wide open, is knowing the difference between investing and speculating. Is there income associated with investment? That means it has a positive return. So not trying to complicate things too much and not get caught up in the latest fad is investing with your eyes open.
Some people have told us that their employer doesn't offer any type of 401k, 403b, 457, nothing. What do you advise people in that situation to do in order to get started with investing?
You open an account at someone like Vanguard or Schwab, and you can put in after-tax money, and you can set up an individual retirement account, so you can put tax-deferred money. They all have commission-free exchange-traded funds, so you're not having to pay a commission. Or you go into basically a commission-free type mutual fund and just get started. I mean, you start small. Just because your company doesn't offer it or doesn't offer a match, you can still invest. And it's important that people, what I tell people is that you should be saving 15 to 20% of your income just to be able to save. Because you think about it, if you're going to work 30 years and be retired 40 years, I mean, you're going to need to be able to save. You can't do that on saving 3 to 5%. And so when you're young, you just have to get in the habit of saving so that you're there. Now, hopefully there is a match so you can get up to that 15 to 20% with some type of company match. But if not, then it has to be part of the discipline to save. And it's hard. It's hard to put off things. But if you start as early as possible, try to automate as much as you can. When you get a new raise, go ahead and just figure out, I'm going to allocate any new raises to my savings. So you just get in that habit of saving.
Now, for those people, they'll go to like a company like a Vanguard and they'll try to open up an IRA, and they'll have the option of going with a traditional IRA or a Roth IRA. Is one better than the other? Should we do both? What's your advice there?
Well, one is pretty much, I'm not a financial advisor planner from that aspect. I mean, I don't get overly concerned about which one. I mean, you look at it, it kind of depends on what your tax rate's going to be at the end, whenever you retire. Just start. I mean, for example, I don't have a Roth IRA. I just have always had a 401k. I rolled it into a traditional IRA, and I just don't spend a lot of time trying to optimize that. I think it's more important just to save. And, probably start with a traditional IRA. Maybe you can have a Roth, also have some of both. But I think people get too concerned about that nitty-gritty detail. In the beginning, it just doesn't really matter.
Because it's another term out there that's out there a lot, and I don't know if it matters to the average person, or maybe it's super important. But the term asset allocation, what is that, and is that something we should be concerned about?
Well, that matters, but what that is just making sure you have a number of different asset types. You have stocks, you have bonds, you have real estate investment trusts, which are publicly traded securities that invest in real estate. You don't have all of it in the U.S. stock market. Now, some people have 100% of their stock investments in the U.S. market. Well, the U.S. market only makes up 50% of the global stock market. So you're missing out on half of the opportunities and making a big bet just on the U.S. So asset allocation just means dividing it up into as many different asset drivers or performance drivers as you can. And it's not that important the percentages, right? I mean, you generally we want to have the older or the younger you are, you want to have potentially more in stocks because it has a higher return. But the right number in each percentage or bucket, it's not that important in the early going. Just making sure you have different types of assets. So as you learn about the options in your 401k, if there are other different types of them, then invest in the different types. And that's how asset allocation is. So that there's times when something does very well, and there's times when different asset types don't do as well. And so having things that offset that is important.
So if I go to whether my 401k options or if I go to outside source like Vanguard or Schwab, you said the percentage doesn't matter, but some of the categories or asset classes that I should be looking at are stocks, both U.S. and foreign, bonds, right, REITs, which is the real estate option, if they have it. And is that it, or there are some other categories that I should be looking out for?
Sometimes they'll put in, like within, they'll have U.S. stocks, they might have non-U.S. stocks, and then they might have a separate emerging markets stocks, which are companies that are countries such as China and South America that are developing. But again, if somebody's plan just has the target date fund, that fund already is practicing asset allocation under the hood. So they will have those different types of assets within that fund itself. So that's sort of the best place, the easiest place to start. And then, so if you start a new job, there's a target date fund. Start there, and then that gives you time to kind of learn about the other assets. Because oftentimes, when somebody new, they'll just, I'll just put it in cash till I figure it out, and then they forget about it. So it's best to get it involved in a target date fund, so and then learn about the other options. But yeah, you're right. Those are the basic assets that you could invest in.
And we also have a lot of parents that tune into the show. And, not only do they have a desire for themselves to get involved, index funds, mutual funds for themselves, but they also want to put some money in the market on behalf of their kids. Are there options out there for parents that want to do that? Do you recommend it? Do you not recommend it? What's your thoughts there?
Well, there are, many states have what are called 529 plans where they're tax deferred and you can save for college. I mean, that's an option. I think for most parents, just saving. I mean, it's like in our case, I remember once we went out and I think I put $100 to save for our kids, and I had an advisor come and we put it in a very, very expensive fund that didn't do very well, thinking I needed to do something separate. Well, I realized I just needed to save. Needed to save from our retirement, but I could do after-tax savings in my account. Didn't have to be in my kid's name, because I don't know what my kids are going to be like in 20 years. So to put something in their name necessarily, let's just wait and see what the world's like. So just save as much as you can, both within your 401k, but also after-tax savings. So that, because most people, once you might be able to max it out, but it's helpful to have both after-tax savings at an account like Vanguard or Schwab, as well as within traditional retirement savings, because that gives you that flexibility to help your kids down the road in whatever way you want.
Does investing in the stock market affect our taxes? If so, how?
Well, if within like a 401k, it doesn't. I mean, in some ways, it saves you taxes because you can defer that income so you're not being taxed in terms of your income. A lot of times, members of my website, they get really worried about that. They've been investing a long time. They don't want to sell something because they're going to have to pay tax on it. Well, that was never really their money anyway. They sort of have already in their mental account saying, well, this is my money, this is my gain. And I realized, well, no, it really wasn't. It's your gain after you sell it and you pay taxes on it if it's in a taxable account. But for most of us, we don't spend a lot of time worrying about the tax consequence of investing, particularly in the early years. Put as much as you can in an individual retirement account or in your 401k. At some point, as you retire, you'll pull that out, and there's some taxes involved in that. But don't let taxes and the fear of taxes drive your investment decisions and your savings decisions. Just save and invest and learn the basics, And ultimately, if you're a successful investor, you'll get to pay taxes. So, I mean, in some ways, it's a reward. It meant you did a good job investing.
As we wind things down, for those who heard all your great advice and now they kind of feel a little bit better about the potential that they have with investing in the stock market, what are a couple of things they need to do after they get done listening to this?
Well, I mean, make sure you're participating in your 401k at work. And if you're not, then open up an account at Vanguard. I mean, you call them up, you open an account at Schwab. They'll help you. Or you can do it online. And then look for commission-free ETFs and buy one or buy two. Start with a global stock ETF, for example. And start with that and just get in the habit. If you want to explore investing more and just sort of what does it feel like to buy a stock, then get the Robinhood app and you can buy a stock commission-free. But just get started and just recognize you're not going to be an expert. You don't have to be an expert. You can learn little by little. But there's important things that we need to know about investing, and we don't have to be an expert to do that.
I think another great resource for everybody is a podcast by the name of Money for the Rest of Us. So can you tell everybody more about your show, the resources that you have, and how they can stay in touch with you?
Sure. I mean, you can search for Money for the Rest of Us. You can Google it. It's on all the major podcasting apps. And in the show, I don't do interviews on my show, so it's basically a story-driven type podcast. So I'll spend 25, 30 minutes just teaching and telling stories related to that principle. And the idea is to really just focusing on big picture. So we'll talk about some nuts and bolts of investing, but we'll also talk about the overall economy. I did an episode recently after there was a whole issue on the tariffs on steel and aluminum. Well, I didn't know whether that was a good or bad decision. So we spent time, 30 minutes exploring that. Is this good or bad? How does it impact our investing? How does it impact the economy? What is money? What is money and how money is digits and things of that sort. And so I like it because it's whatever I happen to be interested in that week. Get a lot of suggestions from listeners, and we just spend 25, 30 minutes together. And I would include it if you want to learn about investing, including in one of the many podcasts that you listen to, including His or Her Money.
Awesome. David, this has been incredible. I think we all feel a little bit better about going into the stock market and building wealth. So thank you so much for taking time out of your busy schedule to talk with us today.
Well, no problem. I very much enjoyed it. Thanks.